Hello, everyone. Welcome to the 7-minute workshop during which we chat with experts to break down complicated and timely topics that affect your business. And we do it in just 7 minutes. Usually takes me longer than that just to find the TV remote. And today actually starts a new beginning for the workshop. From now on, we'll be focusing on month-long themes that are essential to helping your business continue to grow. And this month, we're focused on accounting processes and how to improve them to help your business run more efficiently as you scale. And to help us with this, I'll be teaming up with Netsuite Senior Product Marketing Manager, Scott Beaver, throughout the entire month. Now, for today's topic, we're diving into accounting for investment income. We'll talk about what it is, the benefits of investing for your business, the challenges around it, and how NetSuite can help you manage it. But before I bring Scott on, a quick reminder, if you have any questions throughout today's discussion, you can ask them in the comments, and we'll get to them at the end of the conversation. And please don't forget, tell us where you're tuning in from. Drop us a hello, a bonjour, a ciao, maybe a good day, mate, or even, you had me at hello. We know you've signed on from all parts of the world. I'm here in the Middle East. We'd love to give you a shout out right back. So without further ado, please join me in welcoming Scott Beaver. Hi, Scott.
Hi, Fritz. How are you?
I'm doing great. It's great to be with you here on this fine Thursday morning. Actually, it's nighttime where I am. But first, why don't we just kick this off and kind of maybe for starters, really define what we mean by investment accounting.
Yeah. So technically speaking, there's investment accounting and there's accounting for investments. So investment accounting, which is a slightly different topic, is an investment accountant would be someone who works for, say, a private equity firm, sure, or an investment firm, and their job is to help manage those investments or help accounting. But accounting for investments are treated slightly differently than expenses and revenue. So it's that process of capturing unrealized or realized gains and losses. That's really what accounting for investments is all about.
Right. And so maybe if we could just take maybe even one step back and talk a little bit more about why are companies making these investments and how do they benefit from them?
Yeah, that's a great question. So many businesses generate surplus cash over and above what they need to operate, or perhaps they have funds that they've raised in a VC round, what have you, and they want to make the best use of that. So the options are I either invest into assets to generate revenue, or maybe into another company, or I invest in financial equity or debt instruments or private equity. So those are really the two big types of investments. And I'm doing that to make the most of the capital that I have. Again, either it's a CapEx where I'm trying to buy a new piece of machinery, or maybe I'm investing in T-bills or some more short-term equity just to keep that money moving, so it increases in value ideally.
So you got a bunch of surplus cash. You need to make something with it. If you don't have anything immediately, you might turn it into debt or equity instruments. Otherwise, you're going to do some sort of capital acquisition.
Or, again, if you're a private company, you might return some of that, even public company, return some of it to your investors, of course. But, from an investment standpoint, it's really about how do I make the most of this money that I have by growing the business.
So just to kind of summarize, what are the common main types of investments that you would be classifying for a business?
Yeah, there's really, I guess broadly speaking, there are four categories. The first two tend to deal with short-term or current assets, and they're often treated as like cash. So they're cash-like investments, and again, that tends to be either investments that you hold to maturity, and that again, that's like your treasury bills, CDs, et cetera, that you're going to keep on, hold on to until they mature, and then you're going to take advantage of the increase in value during the lifetime. Then the other for the short term is your equity investments. That your hope is that they increase and they generally tend to be held for 52 months or less. So, really current assets as well.
Got it.
So that's
let's
those.
move.
Then the other, just flip side, the other side of that would be, assets that I buy and want to sell. Maybe they're no longer useful to me, or I hold on to them as an alternative investment to generate revenue in the future.
Got it. So let's talk a little bit about some of the challenges with accounting for this investment income.
The biggest issue is you're not dealing in the terms that accountants are used to dealing with: asset, liabilities, expenses, revenue. You're dealing with gains and losses that may be unrealized. So if I make an investment in a stock, and that stock, the market value of that stock gains, I have to record that. I have to keep track of that, even though I'm not necessarily receiving additional revenue from it. So it impacts my balance sheet, even if it doesn't necessarily impact cash flow. And then when I actually sell one of those assets, that's when I have to recognize it in terms of revenue from non-operating activities. So that's kind of that's the big challenge there. And then just keeping track of the value of all those things. That, depending on how much I have invested, that can take up a lot of time.
And are there any tax implications that are different than any other sort of revenue or loss?
Yeah, and again, it depends on the type of investment and what my intent as an investor is. If I have a piece of equipment I'm selling, when I sell that, even though I've used it in the business, that is a gain or a loss, and that's one thing that I have to look at. But the real issue is with equity investments or assets held to maturity. Those are often taxed at a different rate than corporate revenue. And depending on how I account for those, I'm having to look at, well, what's the difference from when was it my initial purchase price? Am I selling some portion of a holding, but not the entire thing? So those are that can be really challenging.
Got it. So we talked about some of those challenges. What are some of the ways that businesses can simplify this or overcome some of the things that you listed?
Yeah, the first issue is having really good records. I mean, you absolutely have to document anything you invest in. Right now, we're talking about sort of the current assets. Anything you invest in, you got to know how many shares you purchased, what the share price was, and the date. And then when you go to sell those, from a tax implications, be able to say, this is why I'm recognizing this much of it, for tax purposes. So that's important. Same would be with a debt instrument. So that's really important. In terms of longer term assets, like, again, a piece of equipment, maybe I'm holding on to some property that I intend to sell, tracking depreciation on those assets over their lifetime is really critical, because you're selling it for the current market value, not the price you paid for it, and how often, whether you use that asset or not, or whether you're just holding on to it, intending to sell it, that all impacts the value and ultimately the amount of revenue you generate, and whether it's a gain or a loss.
Got it. Okay. I want to do some quick shout outs. We have some people clocking in here from London, late at night there. Thank you for tuning in. Toronto, Mexico, and also the Netherlands. So we're hitting Europe and Canada and our friends to the south in Mexico as well. Thank you guys all for tuning in. Keep giving us shout outs. We're gonna open it up to some questions from the audience as well. So for those of you tuning in, if you have any questions, keep putting in the comments, keep shouting out. We'll do our best to say hello, and we'll try to answer as many questions as we can in the remainder of our time. So let's get to the first one, Scott. How do investments like this specifically impact cash management?
That's one of the big reasons I'm investing in making these current assets or light cash investments, because I need that flexibility, that liquidity to manage, meet my liabilities, my current liabilities. And so that's part of my cash management strategy is, how much do I keep as working capital? How much do I invest? So that's really what cash management is all about, is having that strategy. How am I capitalizing my business basically? And how much liquidity am I keeping in investments versus, checking versus et cetera. So.
I had kind of a question I want to squeeze in here about, when to cut. I mean, everybody's always trying to figure out what to do, what the best way to deploy capital. But, when you talk about using it for equity or debt instruments or things like that, I mean, is that really a common, is there a particular size that a company gets at where they can afford to really look at those kind of things? Or, do we see some of the smaller companies doing it? When should companies be thinking about that sort of thing?
Yeah, it has. There's a couple of things here. It's all, makes a lot depends on how much cash you actually generate and how frequently that cash turns over. Very large companies. I was once told that a company like Siemens, for instance, is a bank with a hobby. They make a lot of their money off how they use their money, not just from what they sell, but how they manage that money, et cetera. So very large companies, the investment strategy is critical. Smaller companies, it makes a lot of sense, rather than say taking profit as an individual for, say, an S corporation or a partnership. Many times it makes more sense to invest that. So depending on how the business is structured, depending on how much cash they're generating, yeah, absolutely. And I would say a lot of companies at a minimum have a CD if they're generating enough cash, just so, hey, I'm making something on it. I'm getting some earnings. So
got it. Okay. Next question is, how does NetSuite help companies? There's our selfish question here. Glad we can ask it. How does NetSuite help companies with this investment of the accounting for your investments?
Yeah, there are three ways. One, as I talked about, it's so important to document when you acquired equities that that are going to change, when the value is going to change frequently, and so just having that recorded in your accounting system is pretty critical. For held for sale assets, you want to be tracking their value as it changes over the lifetime. So that would be your fixed assets. So that's one area where NetSuite excels, is both manage the ability to manage everything that goes into the acquisition, the maintenance, and ultimately the resale value of both tangible and intangible assets. And then the third category is those investments, those equity investments where I'm acquiring portion, generally 20% or more, of another company. Depending on how I structure that, I may want to treat that as a subsidiary where I'm tracking results. And so that's another part of how NetSuite manages, helps manage businesses. It's not necessarily a fully owned subsidiary, but it's one way of tracking the value and the revenue that's being generated from that entity.
Great. We have one other question. It's not probably one we're going to answer here, but I do want to acknowledge it, which is, are there any plans of adding integrations for crypto investment platforms to NetSuite? And our purpose here is not to talk about any investments. We do have Suite World coming up in October 18th through 21st. Any product announcements we would usually make at that point. But it's a very interesting question, actually. It's one I've sat back and pondered myself and what that would look like. But
actually, let me speak to that just a little bit. Crypto digital assets are pretty interesting. And how they're treated differs from one country to the other. But at least in the U.S., while we think of them as investments, from an accounting standpoint, many CPAs don't treat them that way. They actually look at them as like an intangible asset. So if the market value declines on a stock, you record that as an unrealized loss, and when it goes back up, you record that as an unrealized gain, as long as you don't sell it. But with an intangible asset like Bitcoin or NFTs, it can go down and you have to treat that as an impairment. But if it goes back up, it stays the same on your balance sheet. So in that case, with those kind of assets, they only move one way, and that's down. at least until you sell them. So that's kind of a difference between digital assets, treat it for investment, and other types of investments.
Yeah, I mean, I don't think we're going to take also, you're talking about NFTs. Like, I was thinking we would take the original digital version of the NetSuite logo, or maybe even Sweet Stanley, you know, and make an NFT there and sell it. But anyway, it's very interesting area for sure.
Yep.
I think, Scott, that's all we have time for today, but I want to thank you so much for joining us, and we look forward to speaking with you again.
Yeah, me too. That's a great topic, and I appreciate the opportunity.
Great. As always, a big thanks to all of you for tuning in. We'll be back with Scott again next week, as I said, and we're going to talk about project accounting fundamentals. Now, that's going to happen on Tuesday. Yes, Tuesday, July 20th at 11 a.m. Pacific time. We will see you then.